Stocks wavering, but trying to poke up there in the green as we kick off the busiest weeks of fourth quarter earnings season. You have 6 Dow members and a fifth. 105 companies in the S&P 500 going to be opening up their books. Joining us now, Barron's markets reporter Jacob Sonenshine. So look, trying to get to new highs, but is this a healthy market if it's all relying on big tech?
No, not really. And I think the market has gotten healthier in the last few weeks. And I am a long-term bull on the S&P 500, partly because of tech. I think we need a healthy pullback in the near term. Obviously, if big tech earnings are pretty good, and I don't think the valuations are out of control, those stocks will go up, and you will get to even more highs for the S&P 500. You have all the other stocks reporting earnings, and they look reasonably priced, but there is downside risk. They're not as cheap as they possibly could be. So if you get deterioration to demand and to margins, which I think could happen in the next few quarters, you get bad guidance, that's not going to help the S&P.
Can we talk about the Fed on Wednesday? Because I think the market and most investors have realized they're not going to get the 5 or 6 rate cuts they were expecting in 24, but they want to hear what Powell has to say and when they might get the first one. So that's kind of the read between the lines. But you think people will be disappointed by what they hear?
Clearly, we're getting rate cuts this year, but you now have a bond market and a stock market that has priced for, rates down and stocks up in the last, month or two, priced for an aggressive rate cutting situation. So I don't think we're getting a rate cut in this meeting. Even if we do, I think the markets are priced for, hey, that the Fed is going to come out and indicate that there's going to be several rate cuts, many rate cuts from here. I think that's going to be tough. I know that real rates are up a lot, but inflation remains at 3%. The goal is 2%, and you still have the economy, pretty hot. So I just think it's going to be pretty tough. So the Fed might disappoint the stock market.
Okay. So you think that the market's still pricing in aggressive rate cuts? I kind of feel like after last time, they realized it's not going to be Goldilocks, but we'll get something.
My concern, I'll just say it real quick, S&P at 19 times earnings with a 10-year Treasury yield at 4%, which is down a little bit. 4%, the S&P should be at 17 or 18 times. There are reasons that it's not. And at 4%, what if it moves to 4.5 to 5%? And already the stock market is super expensive. This is a concerning setup to me into the Fed.
Got it.
I don't love that President Biden's talking about sending more federal money for advanced chips. He's been on this chips thing for quite a long time now, but how can we play it to actually make some money? Because I think it's going to happen.
Yeah, so the chip spend is going to be all right. But if you look at a few chip makers that are very globally diversified in terms of revenue streams, you don't really have to be too fixated on the Biden situation. And I'm with you, by the way. But when I look at NXP Semiconductors specifically, that stock is at about 14 times forward PE. That is extremely cheap for a company that has almost no debt and tons of cash relative to its size, and a company that's talking about hopefully a bottom in the automobile market. It could get worse, but going forward, this is a company that's selling chips to electric vehicles. There's top-line growth, there's inventory management, there's margin expansion, and it's too cheap for that type of long-term story.
We love to talk about the picks and the shovels, the things below the headlines. That's a really good play. You don't have to love the federal subsidies, but you can make some money out of it individually if you know how to play it. Jacob, that was really great. Thank you for the insight.